John, good to see you. Today we're going to talk through 5 tips for tax-free Roth IRA distributions. The benefit of funding a Roth IRA is, of course, the availability of tax-free distributions in the future, but the rules can be complicated. So let's break it all down. First, of course, we need to follow the ordering rules. What does that mean?
Yeah, so I want you to think of your Roth IRA as a 3-layer birthday cake.
Okay.
And on the top are your contributions. That's what you've put in. You've contributed directly to your Roth IRA. That second level of the cake is your conversions. And this is where a lot of people fall. Maybe you never made a contribution and now you're talking with an advisor and you're doing some proactive tax planning and you're converting IRA funds. That second layer of the cake is conversions. Then the third layer of the cake is earnings. So when we're taking our bites or we're slicing up this cake, the way the money, if you were to take a distribution from your Roth IRA, the way the money would be considered coming out is any contributions first. So let's say, for an example, you put $50,000 of Roth contributions in. That's the first money, if you ever took it out, that would be counted. Now, let's say your second layer was $200,000 in conversions. After the contributions, then the conversions would be considered to be taken out. Then let's say you earn another $100,000 in earnings. That's the last money that would be considered. So it's the acronym first in, first out, essentially.
Right. All right, next, your contributions are always available tax and penalty free. We have talked about this before.
Yes, so there is no 59.5. There is no income tax. There is no penalty. This is for contributions only, though. So let's say you made your contributions, as we said in that first example, you put $50,000 in over the years, and now for whatever reason you need it, and that 50,000 has grown to 100,000. The 50,000, the first 50,000 that come out will be tax and penalty free. But once you go over that $50,000, depending if you're age 59.5 or over, you're going to have some issues. So again, I'm going to repeat this multiple times throughout the video. Roth IRA money is the most powerful money because it's tax-free compounding. So that would be in an emergency situation. But yes, contributions only. That top layer of the cake is the only one that is tax-free and penalty-free at any age.
Also, next, watch out for the 10% penalty on converted funds. Converted funds are always distributed tax-free, but that doesn't mean you can tap the money before 59.5 without penalty.
You have an IRA and you're choosing to pay the tax now, convert those funds to the Roth IRA. The conversion is the second layer of money that comes out. So if you are under 59.5, you are going to face a 10% penalty. So really, again, don't touch this money if you don't have to. But after 59.5, that penalty drops off. So if you have to tap into your conversions, you definitely want to wait till after age 59.5.
Next, of course, know when earnings are tax-free. We do have to meet a few requirements for the earnings to be tax-free. What are they?
Yeah, so the earnings, this is the most complex part of the cake, the bottom layer. First of all, the earnings, you have to meet the 5-year, which we'll talk about next, and you have to be over age 59.5. That comes with an asterisk to avoid the penalty. Other issues that could help you avoid the penalty are first-time home buyers, disability, and death, which you're really not going to be taking advantage of that money anyways.
Right. No. All right. So now let's get into what I consider the messiest one. Because, John, the reason that we're doing this video is because everybody hears Roth. We think tax-free. We think it's going to be straightforward. It's not. And here's, to me, the messiest part. Understand the 5-year clock for qualified distributions of earnings. The 5-year period is confusing. So break down what we need to know, please.
Yes. And this is confusing for a lot of advisors, too. So the 5-year clock you have to have 5 years for earnings to be tax-free, and penalty-free. Now I say the tax-free and the penalty-free. Here's the thing. Conversions, right, after 59.5, the earnings on those conversions, even if you're over age 59.5, they're not going to be subject to a 10% penalty. But unlike the conversions, they could actually be subject to income tax. So again, you want to be over 59.5 with your earnings to avoid the 10% penalty. If you're before 59.5, you're always going to think 10% penalty on conversions and earnings. But this is where the major confusion happens, because people get conversions and earnings. They think they're two in the same once you're past 59.5. After 59.5, the conversions are tax-free, but the earnings on those conversions are not. Every conversion you make has a 5-year window. So if we are getting down to this base layer of the cake, that $100,000 that I use in the example, then you need to understand that if you convert it and you're taking out the earnings on those conversions at each conversion you make. So if you made a 50,000 conversion in 2024 and in 2023 and 2022, that if you didn't have that, the earnings off those conversions, if you're within that 5-year time period, they're not going to be subject to a 10% penalty, but they're going to be subject to income tax. And folks, you converted these funds to be tax-free. So you're kind of defeating the purpose. You need to understand this. This is extremely complex navigation. We're trying to simplify it. So again, the ending topic for this is Roth IRA money is your most powerful money. Let the money grow.
Yeah.
Compounding, tax-free forever. Let that money germinate and grow.
Right. And then just a bonus tip for everyone. If you are younger than 59.5, make sure you pay the tax on conversions with outside after-tax money to avoid that 10% early withdrawal penalty.
And hat tip to Aaron. You have just grown so much in this.
Thank you. You've taught me a lot.
Tax game. So in generally speaking, actually, you really want to always avoid paying the tax on your IRA conversions with IRA money. As a general rule, you always want to pay the tax with either bank account money, not your emergency savings, but extra bank account money, or if you have an individual brokerage account. For a lot of retirees over 59.5, they may not have a choice, right? They've saved up all their money in their 401k. It's not an ideal solution, but it's better than not converting. But if you're under 59.5, right? 59.5, right? The kids say 6, 7 these days. We say 59.5. Do not pay with your IRA money, because then you're not only going to pay the extra income tax on it, but you're going to pay the 10% penalty, which in really very few cases is going to make sense for a conversion.
59.5 will be my new Halloween costume, because I was going to do 6, 7. Yeah.
We're gonna make that. They said 6, 7 is actually a word in the dictionary. They're adding. Now we're gonna add 59.
It's not a word. It doesn't mean anything.
I don't. Yeah, listen.
But
I've got young kids, so
I do too.
Plenty.
Yes,
I've heard it plenty. 59.5.
59.5. We'll make that cool now, John. It's starting here. Everybody watching, you are the first people to experience 59.5 as the new trend. So, John, if somebody would like to talk through, I mean, this really is Kafka-esque in some ways, all these rules about Roths and conversions and the clock and everything else. What's the best way to reach you?
Yeah, so visit our website, www.gosecurus.com. We've got a lot of videos on Roth conversions, but while you're on there, if you have any general questions or you want to schedule an appointment, click over to the Contact Us tab. We have an appointment scheduler that will help direct you to either a 20-minute phone call, again, where we'll ask any general questions, or if you'd like to take advantage of our services, you can go ahead and book a clarity or a vision and clarity consultation, and we will get you on our books.
Great. John, thank you very much.
Thank you, Erin.